We were talking about policy objective of raising, 100 plus billion. That's number one. But also, number two is deepening our capital markets. This is an opportunity for us 18 years later to onboard, or at least, have not less than 2 million Kenyans, participate in this particular issue. So our objective number two would be to democratize the ownership of this national asset, that is KPC, to offer it to as many Kenyan as possible. We're talking about public offer, so it's not about boardroom deals. It's not about selected fews, having conversation on the side as to the ownership of that particular conversation. The third one, which is equally important, it is to unlock the potential of KPC. As we all know, KPC as a state-owned enterprise, I'm talking to the team here, they go through a very lengthy process when it comes to, perhaps operations. Okay, we start with, the various acts you have to comply. Procuring a venue like this will take you probably a whole process, complying with the PPDA, complying with PFM, and so forth. When it comes to staffing again, SRC will be looking at you. If you're talking about the budget process, it's a whole thing, going all the way to the treasury, and so forth. So really, in terms of, agility, in terms of decisioning, we believe that, post-IPO, the company will be much more responsive. And again, unlocking its potential means accessing, capital markets as a way of accessing cheaper financing. We strongly believe, KPC post-IPO will be actually able to issue. Why not? A bond program, to fund the expansion, for instance. So if I was to summarize the objective of this privatization, we're talking about, number one, raising non-cash, non-debt revenue to the government of Kenya. Number two, we're talking about deepening our capital markets. We talked about 2 million retail investors being onboarded. And number three, it is unlocking KPC potential. And if you look at what privatization did to this company, is precisely to the last point of unlocking the potential of KPC. If you think about the capacity that Kengen has been able to finance, or rather to expand, it's been through actually the capital market. The expansion of Kengen capacity has come through the capital markets, whether it's the Kengen right issue 1 and 2. And then if you look at Safaricom again, we're talking about a company enjoying the benefits of privatization. I mean, in many ways, I do not want to pause to really talk about that. The same standards would apply to KCB. So what are we saying? We believe strongly that this is the right thing. And the minister is on record saying, well, we're not in the business of competing with the private sector. We're not in the business of doing private sector business. Our job is policy. And then we're happy actually to invite Kenyan and other investors to actually own this asset together with the Treasury so that we can unlock its potential. Again, to this chart, looking at it, well, a few weeks ago, if we were to share this chart, you realize that we're talking about 35-65, that is GOK, 35 at Safaricom, 65 private. It has since moved. We're talking about 20% since the sale of 15% of GOK shares a couple of weeks ago. But then the point being that post-IPO, we expect the benefit of the private sector to accrue to KPC. This is the IPO perspective from, just taking stock of history. This is where we are, the largest 208 being Safaricom at 50 billion. And then today we are talking about 106 billion with KPC, making it the largest ever in our region. And perhaps, I'm sure the questions will come, but then take note of the pricing of some of these IPOs, okay? So if you look at it, we're talking about, 9.5. Yeah, I mean, it couldn't have happened in a better time. When we talk about macroeconomic environment, we are in our best moment when it comes to new issues in the stock exchange. Looking at our macros, our GDP has, upticked favorably. We have a stable currency. Our inflation is within the CBK, in fact, just below 5%. And we've seen our interest rate coming down, the CBR 400 basis point to 9% today, and then the yield on the fixed income coming down significantly. What that means is, when you're looking at low return on the fixed income, there's a reallocation. You see some shift from an investor's perspective into the equities market. And our Nairobi Securities Exchange has been on steroids. As you can see, we're talking about 55, 57% year to date in terms of return. So looking at that environment, for us, it is the best entry point to introduce the KPC discussion to the market. So this slide is just to appreciate that we're doing this in a very favorable market condition. We're talking about a valuation that will be discussed. I'm very happy to get down to that. But then a price of 9 shilling, and then we're talking about the issue share of 18.1. Those are the total, and then the offer shared being 11.1 billion. Just to take this opportunity to highlight that we did go through a share split with a ratio of 1,000. KPC, traditionally we're talking about 18.1 million shares. And then when the conversation of pricing comes about, you realize that, to open it up to the public, we had to increase the number of shares. We're looking also at a free float. There's a requirement by CMA to have 15% of our float being free, that is, easily tradable. So we wanted to onboard as many investors as possible, and as you can see from practice and from history, the broader the number of shares outstanding, the better. And also it allowed us to keep the pricing at a single digit point. That's an important consideration when it came to the share split. Again, we'll talk about the basis for setting the price, which is EBITDA highlighted there, and a multiple of 8.1x. Minimum amount, that's 100 shares at a price of 9 shilling, giving us, a minimum entry amount of 900 shillings. The allocation, I think that's highlighted again in our IM, where we're looking at a fairly balanced allocation with the internal KPC stakeholders being at 20% of the 65%. The 20 is basically allowing the KPC staff at 5% to have a priority pass when it comes to the investor pool. I do not want us to confuse this with an ESOP, because there's been a lot of talk about employees being allocated 5% ownership of KPC. First of all, it's not 5% ownership of KPC. It is not about ownership, it is about the investor pool, and that 5% is of the 65%. Because remember, we're talking about the offer shares, the 11.8 billion shares that are in offer, which constitute 65% of the valuation. We're saying there, this is basically the distribution in terms of priority. So employees at 5%, the oil marketing companies being significant shareholders of stakeholders of the company, upon recommendation and various engagement, it's been agreed, to allocate up to 15% of the 65% OMCs. And then we have 20% to our local retail investors. We have 20% to our local institutional investors. We have 20% to our regional investors. Within East Africa, those are the member state of the EAC, excluding Kenya. And then last but not least, our foreign investors are 20%. So it's a rule of 20. If you come to think about it, outside the OMCs and the employees, which still talks about 20, everything else is 20. That is, the local retail, the local institutional, the regional, and also the foreign investors. Yes, so post-IPO, this is the shareholding structure. Post, 35% is non-dilutive, very important. If you look at the sessional paper, the mandate is very clear that at all times the government of Kenya shall maintain 35%. So for market practitioner, what that tells you is post-IPO, even if we were to go through right issue, just imagine what will happen. You would have to onboard GOK into that discussion, at all times, so that the 35% is maintained. And then we'll be talking about 65, which is now owned by the private sector. So essentially, we are not selling KPC, we are selling KPC shares. It's It's an important distinction because the narrative out there is that we're selling KPC. We're selling KPC shares. So that is sharing the ownership of KPC with investors, primarily local investors. In terms of timeline, important dates, we opened the offer on 19th of January, going all the way to 19th of February. So we have a 30 days window that is open for scrutiny, application, subscription, etc. During that period, we're very happy to engage, very happy on one-on-one on platforms such as this one. And then, pretty much the results coming out on 4th of March. And then we'll be talking about payments the next day. But let me clarify that payment the next day are for those who have issued IBGs, because otherwise, if you're retail, we expect you to have not only a valid CDS account, but that account, should be funded, so payment, there's a significant discussion, this is not an offer on credit. Well, in terms of trading, I think again that particular calendar is indicative, subject to changes. We hope that His Excellency will be opening, and therefore we cannot really crystallize that particular day. So this is an indicator timetable. In between 5th of March and 9th of March, of course, there will be processing of refund, there will be crediting of the accounts, and so forth. What happens next is we're excited to introduce to the market on day one, and we believe that will be sustained. On day one, we are introducing the 5th largest capitalization at the stock exchange. The 5th largest capitalization. So really, we are discussing the next blue chip company at the Nairobi Securities Exchange. So we've been able just to show investors what we'll be dealing with, a significant constituent of the NSE 20, and in fact, among the top 5. So when we talk about that, it means the expectations of KPC in terms of, I think these slides have been changed quite significantly. Yeah, now going just into the summary of the financial statement, the statements are provided for in the reporting accountant's report in details with notes. Then as we are summarizing that here in a slide, but then again in the IM selected financial data, there's a section that actually take you through a high level summary of the financial, where you can actually have the detail in the reporting accountant report with notes explaining pretty much, every other entry. But then in terms of highlight, we're happy to note that we're dealing with a large cap. Revenue-wise, we're talking about last year, the most recent financial year, which ends June 30th. It's important to mention, we're talking about 38.5 billion. Now, June 30th, we ended the financial year. So technically, when you look at the prospective financial information, we're talking about H1 pretty much having been achieved. So between July 1st and December 31st, the company already has, from a management accounts point of view, has gone through H1. So our expectation for the analyst forecast is that now we're looking at another, give or take, 5 months. So some of the discussions that we'll be having, is from a point of we can already have a feel for where the company will land in terms of results. And we've also provided, in compliance with CMA requirement, Q1 information. That is, again, in the reporting accountant's report. So we have the first quarter. We had hoped to go all the way to H1, but then again, due to timelines, I believe we thought it would be important to make that disclosure of Q1, which I think we can be discussing that also in detail. So when you look at the valuation, and I want to talk about that briefly, you find that, yes, we're using the EBITDA as at June 2025 reported, but then when it comes to the net debt, which is actually looking at your debt and cash, we're actually taking what is reported in Q1 numbers. So please, analysts, as you look at the numbers, make that distinction that the EBITDA is drawn from the 2025 numbers, but then we couldn't just say, well, in 2025, we didn't have debt and therefore we're happy, to increase value. So we had to make certain adjustments. That is on the revenue side. PBT, I think it's quite clear. Throughput, I'll stop a bit there to say What drive revenue at the Kenya pipeline in terms of granularity is you will be looking at your demand for throughput, but also having a high level understanding of the tariff structure. This is a regulated business by IPRA, and then the current tariff regime, ends in March of this year, but then there's a proposed tariff schedule for the next 3 years. So the tariff cycle is 3 years, and it's important because I think there's a slide on tariff where you actually access, visibility or what is being discussed with IPRA, per cubic meter, and then based on throughput forecast, then you're able to come up with your revenue projection. So when we talk about 9.9 million cubic meters, in liters you add 1,000, so you could say 9.9 billion liters, or you bring it back by 1,000 to talk about cubic meters. These are volumes that pass through the pipe. So Kenya Pipeline is in the business of storage, but more importantly, transportation of fuel. Why I'm making that distinction is because I keep telling audiences that, if we all agree in this room to buy trucks and transport, fuel from Mombasa to Kisumu, then I'm not sure I'll be listed as a comparable with energy stock. I'm not very sure that my truck business will be listed, to be compared with, energy stocks, but we'll come back to that. So really, an important distinction here is on the transit market, what they're calling export. So when you look at that, the export market is significantly higher than the local market, talking about 52% of revenues really being drawn out of export. And I know analysts in the room will say, well, we've read a lot of reports about Uganda, producing oil and eventually refining oil. So really, if 52% of your revenue comes from your transit market, of which Uganda is about 66%, then what happens when they start producing oil and refining oil? I think we'll get there, but the answer is I'm yet to see production, let alone refinery. But more importantly, we're talking about long-term discussions. Production of oil does not necessarily mean consumption of that same oil. So the crude, you find that some countries in the world, for the longest time, produced oil, but without refinery, you do not consume. So there are two conversations. Let's not see headlines of these guys are producing oil and think that that's the end of 66% of the 52% export market. That is not it, because there's still a process, which is when will you put up a refinery? In a country which I think Nigeria being the largest producer in our continent, for the longest time, they could only produce crude oil, and then it will go up, refine, and then come back for them to consume. So let's be alive to those realities and ask ourselves, at what point are we likely to see, a refinery happening in Uganda? So back to this export discussion, we have, the markets of Uganda, but also geographically, there is, an exposure to other member states of South Sudan, to Burundi, to Eastern DRC, to Rwanda. These are markets that are served by KPC. I think we can move on. Yes, this is a technical discussion, but then just to take you through that, we're talking about, 1342 kilometers of pipeline, okay, across 5 lines. So you always hear about, line 1 to 6, but then line 1 used to be what they call the main line, transporting fuel from Mombasa to Nairobi. And when we say the main line, is because really 450 kilometers, that's the source, bringing it to Nairobi, and then from there you have other lines. You have the Nairobi Eldoret line, and then you have the Kisumu Sinendet lines. But then again, that line 1, it's important to talk about it, has since stopped being in operation, I think as of 2023, I believe. The team is here, they'll shed more light to that. And there are discussions happening on decommissioning of that line. But then again, I believe in 2015, the company actually accessed a 350 million USD loan. That was a 10 years loan with 2 years moratorium to build the replacement of line 1. That is what they're calling now line 5. Okay, that was commissioned in 2018. The diameter is slightly bigger. Yeah, it's the biggest of all. So it's a 20-inch. It's the biggest because then throughput in terms of volume, I think they pass probably around 8.8 million cubic meters through that. This is important. So we have the transportation business, but let's also remember about storage. Okay, so as you move around, it's important to think about how does this work. I see some technical words there, but not to worry. The MSP, the Argo, I think we're talking about super, we're talking about diesel, we're talking about kerosene, we're talking about jet fuel. So basically, these are just type of products. And then we're giving you basically the depot, the pump station. PS is pump station. I was told that, those that are odd numbers, we started with odd numbers and then later we went to even. So even, so those are complications we don't need to take you through. I think the most important point is to give you the breakdown of the storage capacity. So when we talk about 1.1 million cubic meters of storage capacity, just look at the last line, which is the KPRL. It's an important discussion, 384,000. That's really introducing us to the value of KPRL, and then we'll talk about it even when we talk about valuation. We have a story of what has been achieved and projection, and I keep telling the KPC management that these were projection as a state corporation. We expect a steeper curve on the projected side, because if you look at that, our slope is not as steep as investors would expect. So really outside the various constraint, the bureaucratic constraint, we expect growth to be much more significant. Again, there's a breakdown that has been provided, which is almost on 50-50 basis. While the governance, it's important because really, when we talk about the value of a business, it's primarily how the business is governed. The memats of this particular business have been revised to comply with the CMA Corporate Governance Standard 2015, but also the POLS regulations. So we have worked with the board and the team to make sure that the company is in compliance, and that gave us an opportunity to actually, by design, set this company to be among the best governed companies post the IPO. So I don't know what I will highlight, but then the MEMARTS is a document that's available for inspection. It's important for investors. But one of the key distinction is that traditionally you have board members appointed by the cabinet secretary of energy in this case, with a rep of the shareholder, a rep of the CS National Treasury, and then the rest of the members were appointed. Of course, the chair by the president. That is going to be a thing of the past. Of course, some members will remain. So in the design of the governance of the company, we're talking about a third of the directors at all time being the rep of the shareholder remaining. That's the National Treasury. So we're removing the state appointed directors, but then going forward, take note that at all times, a third of the directors of this company will be representing the shareholder, which is really fair because we're talking about the shareholder retaining 35%, and therefore pro rata, that is, I would believe that is fair. No significant veto to this particular remaining shareholders because really we wanted to open it up to the private sector. So there's a bit of concurrence on the appointment of the CEO. Outside that, the veto will be probably on a name change and things like that. Change of business, you're required to go back to Parliament, for those of you who have read the sessional paper. So the MEMAT is not restrictive in any way. The MEMAT is, again, not capping investors in any way, much as we are very much aware of the need to be broad-based, of the need not to concentrate this particular asset for national security reasons. The MEMAT has not been expressly restrictive to that effect. So if you have investors out there asking you a question as to whether we can cross the 5% significant shareholding, or whether we can go all the way to 25% and then face CMA with our disclosure. I think here there are no restrictions whatsoever. Again, post-listing, there are expectations on disclosure, there are expectations on reporting, and it is our belief that this company will be put under scrutiny. But then again, we will be working with the company to ensure that through the compliance officer and other support, they get into the CMA way of doing business. This information on financial data contained in the IM, I think quite clear, a very good story. I like stories that are straightforward, no deep. If you look at the revenue, significant CAGR, above 8%. If you look at the prospective financial information, CAGR is at 13%. Significant growth, again, that particular discussion being driven by diversification, where today we have 95% of the business, being core in the storage and transportation. Going forward, I think the GM strategy will talk about that at some point. The company is looking to reduce their reliance on the core to actually diversify away and move that core from 95 to just below 80%. So 20% of the revenue going forward will be looking at other, business lines such as fiber optic, LPG and crude oil handling at the KPRL. So that is what will drive growth into the future. So as you analyze and you ask yourself, what's giving you that 13% CAGR? It is partly diversification, but also, capacity expansion and demand that is expected to grow. One thing on tariffs are volatile. Okay, we don't have stable tariff or increasing tariff. As you can see here, this is actually good. You find that I don't think you can read it. I think you're not. One of the most important drivers of tariff is capex. Okay, so IPA would actually look at how much investment have you been making into the pipeline network and compensate you for that in terms of pricing, factoring that into the tariff. So the company has gone through a freeze, as you know, because of this particular privatization discussion, and therefore there's been very little investments. But if you look at the year 2027, 2028, there will be a significant jump in the tariff, and that conversation also is reflective of the capex that's happening. I think just take me 2 slides down just to highlight that particular discussion. If you look at this conversation, it's been provided for in your prospective financial information in the reporting accountant's report. So if you go to that particular section and you look at your cash flow from investing activity, you find that the company is looking at a capex over the 5 years of 110 billion and borrowings of 50 billion starting from the 3rd year. So please refer to the prospective financial information and just have an understanding around capex. We can take you through some of the major ones. I would say there are 3 essentially. One being what the company is calling line 7. Line 7 is basically adding an additional line, from Mombasa to Nairobi. So supplementing line 5, which is the main line. They call it the eastern line or the main line. So at all time when you hear main line, it's line 5, taking, fuel the 450 kilometers. So line 7 is on the way, and then that capex for 2 years will be around 35 billion. So if you look at, the investing activities, there's a 35 billion, ring fence for the construction of line 7. How will that be financed? Pretty much the same as how line 5 was financed, which is taking a USD denominated loan around the same terms. We're talking about 4.5% plus SOFR, an average 3-month SOFR of probably 3% margin, so 7.5 thereabout. I mean, those disclosures are there in the prospective financial information, and that is how that will be funded. Again, the company is committing to have a structure of 30-70 in terms of equity and debt, or debt equity of 70-30 when it comes to financing their capex going forward. I'm pausing here because from a cash flow perspective, when you're modeling that future, you will need to understand the out and the inflows, and CapEx is a significant conversation around that. As far as loans are concerned, we've also put that in just so that you have visibility as to the financing of that particular CapEx. So line 7, that's one. The expansion of what we're calling the Eldoret Malaba line. So we have another line coming through, and I believe it's around 24 billion, again in 2 years. And then the LPG business, okay? LPG concentrated around Nairobi, taking about 12 billion in CapEx in 2 years. There is a small portion of LPG plan for Eldoret that will be around 3 billion. So really, if you go to the perspective, spend more time understanding the dynamics around capital expenditure into the 5 years, and also the borrowing disclosures into the 5 years. Can we go back a bit? I don't know if I skipped that breakdown. I think we can skip. Yeah, let's continue. Zipler, I think it would be good for you to speak through this. I'll skip this slide for now, but you probably would take us through what we're calling your 5-year strategic plan, the summary, the highlight, what you're calling Vision 2030, what to expect. You know, from this community, they would want to have a feel for where the company is headed. So it would be good for you to take 2 or 3 minutes just to take them through that. I think this is probably the most exciting part for all of us, including myself, because there's been a lot of talk about valuation of this business. You know, I've heard in some quarters that, you know, Parliament had told these people to go and raise 100 billion. What do you expect? I mean, they had to, you know, make it work just around that. I want to say something very important. I think we have to agree that this is a regulated process, okay? Meaning you cannot sit and decide that you want to accommodate certain quarters. When it comes to valuation, it's always a very emotive subject. Whether you're talking about the seller, if you ask the seller, where was your expectation, you know, selling the shares of this asset, not selling this asset. We're not selling KPC, selling the shares of this asset. Where were your expectations? And I can tell you, for those who have talked to the sellers, the expectation was up there. In fact, when we started, the seller was telling us, we expect $2 billion, which is around 260 billion. Say, well, you know, this asset for us, we believe, and we've seen even some videos going around that, you know, there are plans to, you know, strip Kenya pipeline, you know, and undervalue it and sell to a few quarters. That was the narrative then from the general public. The narrative now has changed, and it's, oh, by the way, no, this thing is overpriced, okay? So we are actually alive to the fact that, you know, standing in the middle of sellers and buyers, you know, you do not want to lean towards the seller or lean towards the buyer. You have to do your job as a professional. As a market intermediary, as a licensed, regulated entity, our job was actually to arbiter, you know, that particular discussion and stick to what we believe is the fair value of the company. And we're going to talk about that fair value. So in terms of principle of valuation, what we're saying is we're neither leaning towards the seller expectation or even at times what a buyer would wish, you know, it would land at so that, you know, they can quickly make their return. Now, it's been a process. When you talk about valuation,